We're joined today by Bill McWilliams, the Chief Investment Officer of MaxCap Group, one of Australia's largest commercial real estate debt and investment financiers, to talk about the outlook for real estate capital in 2022. Thanks for joining us on The Urban Developer.
Thanks very much, Adam. Good to be here.
Now, let's start by looking back at last year, 2021. How would you describe the year, and what were both the highlights and lowlights from your perspective?
2021 was, it was a very good year for us, but I won't lie, it was also a very tough year. I think we all thought the pandemic was behind us as of the year prior to that, and it lingered on far too long, I think, from all our perspectives. From MaxCap's perspective, we learned a lot. This is actually our second major global sort of crisis that we've been through. We were around during the GFC. And one thing that we really learned from that crisis was to continue to back our borrowers and our partners, if you like, continue to do the things that we'd set up and put in place, and really continue to back ourselves and our judgment. You know, we don't want to be known as I guess, fair weather type lenders. We really want to be in the market long term and continue to build the relationship. So we really went into 2021 with that mindset, following the difficulties of 2020. And it ended up being a very good year for us. We've grown funds under management to over $5 billion now. So we're sitting at a peak. But possibly even more important than that, I look at the quality of the lending book that we've got. We have zero impairments at the minute. We've got a very strong performing loan book. We've got a strong pipeline. I think we've set the business up really well for continued growth. So working from home had its challenges, I won't lie. We were lucky enough to set the business up with a national platform. So we've got offices in Melbourne, in Sydney, in Brisbane, and in Perth. And having guys on the ground when you've got state lockdowns was really important and helped us continue to grow in those markets. We were fortunate enough in terms of our exposure going into 2021. We weren't heavily weighted to those sectors that I guess were impacted the most via the pandemic. Hospitality, those sorts of sectors. We're big on industrial. We made the decision to go big into industrial a couple of years prior, particularly on the equity side. We've always had a natural weighting towards residential, and there's markets with residential. Obviously, land subdivisions performed quite strongly. That medium density residential's performed quite strongly. And so, yeah, overall, really pleased with 2021.
Now, as we look out to 2022 across the property industry, there's plenty of developers talking about the likelihood of interest rate rises and growing inflation. I mean, what's your read on interest rates for 2022? What's the RBA going to do, and how do you think that will impact your loan book?
First thing I'd say about interest rates is that we've been in a historically low interest rate environment. And in fact, right now we're at the lowest interest rate we've ever been at historically. So I think to say interest rates are going to go up, I mean, that was always going to happen. And we'd always predicted that, you know, the next step would be an increase in interest rates. I could guess at when the trigger is going to be pulled on those interest rate rises, but to me, that's less important. I think we know that it is coming. And I think that the market's, you know, prepared itself pretty well for that, knowing that we've been in this low interest rate environment for an extended period of time. I think APRA have done a very good job at you know, ensuring responsible lending on the home loan side. When I look at home loan books and see how far in advance repayments are, I think it'll keep the market in very good stead. So look, I am expecting to see some interest rate rises. I think the market's prepared for those interest rate rises. But I don't see, particularly over the course of the next 12 months, I don't see it having a huge impact on particularly the viability of the property market.
So then inflation looks like it's really starting to take bite. Obviously, they're interconnected there. You look at household costs, but then also for our industry, we look at construction costs. And they moved a lot last year, and it looks like they're more than likely to move up and escalate up this year. How significant a risk is this to, you know, your developer clients and your borrowers? And I guess, how are you at MaxCap mitigating rising project costs?
Yeah, look, it's definitely been very challenging over the last 12 months, construction costs. It's been tough for builders, it's been tough for developers, and there's obviously from a lender perspective, a lot more sort of due diligence that's done up front. What I would say, and what we've been targeting, particularly over the last 12 months, and where I see, we will sort of continue to look at over the next 12 months, is we've been saying to our borrowers, the best way to mitigate against rising construction costs is to lock it in early. And so, we've come up with some product types to allow developers to get going a lot earlier, so they can lock that contract in early. So, predominantly the hardest thing, or the longest lead time to getting your development off the ground is pre-sales or pre-commitments. And so, we've worked really hard at developing products that allow borrowers to get their feasibility in order. If we've backed the right project, good sponsor, good location, then we're comfortable with the ability to get those pre-sales in the future. Then we're happy to get going now by locking the pricing away, because as you pointed out, those construction costs and ensuring they're locked in is probably one of the biggest risks that developers are facing.
Yeah. And just generally, what's been your approach to lending money to developers and property owners in this respect? I mean, and how is that changing? Are you being more selective about your sponsors in light of all of this? Is it sort of a bit more of a wider net with some lower hurdles? Can you just talk us through how you're approaching developers?
I think, just generally speaking, we've always been very relationship focused and very sponsor driven. So again, we haven't really changed. And back to my earlier comments of sticking through what is a crisis, the pandemic, sticking through with what we know and backing our judgment. It really is about good quality assets and good quality sponsors. We run a number of sort of scenario testing, but where you're not equity in a project, as lender, you're not taking first dollar loss. Developers are taking first dollar loss. So, we run a number of downside scenarios and make sure that from a lending perspective, your lending is always, your dollar is always protected from a loan book. So that's what we do. We've probably run, a lot more stress testing scenarios over the course of the 12 months. But in terms of backing, the right sponsors and projects, we're still here to support those sponsors. We're building our capital to ensure that we're there for the full life cycle of developers as well, which I think is really important. So coming in early when a developer's acquired a site, backing them for that, coming in throughout the construction period. At the end of construction, it's been difficult to liquidate construction facilities just through pre-sales. Or to pay it down. So, often there's a requirement for a residual stock loan, or if it's a construct and hold, some term debt at the back end. So it's really where we've evolved to just being there for the construction portion of the loan. It's really about assisting the developer through the entire life cycle. And
then obviously Apollo's come on board as a partner and 50% shareholder of the business last year. What's that now mean in 2022 in terms of deploying capital? How does that sort of reshift the approach?
Yeah, it's been really exciting. And to date, the focus has been on Apollo's investment in the platform, and it's now we're turning our focus towards the capital that Apollo actually has, not only their own capital, but their relationships with third parties. So look, it's significant capital, but it's capital that also carries different risk ratings to what we've got to date. So we will see a lot more term debt, a lot more of those construct and hold. If a developer wants to do a repositioning of an office asset, for example, might pick up a B grade building and look to refurb and offer incentives. We've got more capital for that sort of thing. And the market talks a lot about the build to rent opportunities. Again, just a straight construction solution doesn't really provide the solution there. So, the Apollo capital really allows us to accelerate that.
And then just finally, we're seeing this kind of non-bank sector really mature here in Australia. There's obviously the likes of yourselves and others, either, floating or bringing on major partners or just generally growing. How do you see the sector maturing, I guess, in the context of the regulatory environment as well? How's that sort of interplay going to play out?
Look, I think that, it's definitely become a legitimate asset class to invest in here in Australia, which I think has been great for developers, particularly, rather than just be, beholden to the policy and the requirements for, what was traditionally bank funding. And there'll always be a requirement for that bank funding. And if you've got the ability to meet those requirements, then there's some good capital there, but it provides a lot more flexibility of capital for developers. And I think that there's still a lot more capital coming into Australia for this asset class, which I think is the good news for developers. It's meant there's been a lot more competition. Not necessarily, a great thing for being a financier in this space, facing more competition than we have historically. But we don't mind that at all. We're happy to have that competition, knowing that probably the most important thing for developers is really certainty of capital, and knowing that when things do go sideways, you've got a lender you can trust. So whilst there'll definitely be a lot more players come into the market and continue to come into the market, I think that borrowers should be discerning about who they use. And then ultimately, I think that will lead to further down the track, potentially some consolidation. But at the minute, I think it's good news for developers that there's a lot more capital coming in and a lot more competition.
Well, we wish you all the very best for 2022. Maybe there's another Melbourne Cup to be won as well within the ranks of MaxCap, but we'll certainly stay attuned to what you guys are doing and wish you all the best for the year.
Thank you very much, Adam. Appreciate it.
Thank you.